You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Hey guys, welcome back to yet another episode, another weekly episode. You know, when I made the YouTube banner of the Young Investors Podcast YouTube channel, I said the almost weekly podcast.
Yeah, I like that.
We've been every single week though. It's not even almost weekly. It is weekly.
Yeah,
we've been, yeah. I know we say this every now and again because it still does surprise me quite a bit that we've been so consistent.
Yeah, well,
it's good.
We'll have to update that banner soon. How many? I wonder when the last time was that we missed a week. Surely it was.
We haven't missed one this year.
So back in January when we started, would have been the last sort of gap. Wow.
Yep.
Done a good job so far.
Because we were struggling last year doing them on the Saturday mornings.
Yeah, that's the thing.
So we'd miss one every now and again, and then kind of at the end of the year we had a 3 weeks off or something just over the Christmas New Year period, and then we got back in and we switched it to recording on the Thursday, and now we're just absolutely powering through it. So
now that I think about it, I don't know how we managed to do as good a job as we did last year with recording it on the Saturday, because we had to record it and then we were also doing the editing at that time.
Exactly,
so that was a crazy turnaround to get that out in a couple of hours.
Yeah, I remember that. Yeah. We were straight, and remember when we'd have a guest on and we'd be like, all right, thanks for coming on, and now that we've finished, can you like send your audio, get it all tidied up and send it to me immediately because I need to get this out in like 2-3 hours. Yeah, we'd get it out, but it never really worked because then we'd release the podcast like at 3 p.m. on a Saturday afternoon, and like that's just not a good time to release a podcast. That is such a bad time. I mean, people have already gotten on with their Saturdays. They're in the middle of doing something else if you're releasing at 3 on a Saturday afternoon. So yeah. No, I think it's good we release it early Saturday morning, get it out there, and then people can watch it, either listen to it over the weekend or if just during the week, as a lot of people do on their way to work or something.
Yeah. So thanks everyone for tuning in, and we're at the beginning of a very interesting earnings season over the next couple of weeks. So we have a couple of companies to talk about. One of the headlines that I just saw come up on my phone that that is kind of a bit of an intro into one of the earnings we'll do, but we'll get to the sponsorship first anyway. But a headline that I saw was Tesla beats earnings by 1,300%. And I was like, wow, okay. Brandon will have a lot to talk about in terms of he'll have a field day and he'll have a lot to discuss.
Well, I don't actually know what the estimates were because, to be honest, I don't really look at them. Because I mean, what use is it looking at what someone else predicts something's going to be when they don't have an insight into the company? They're just the same as me, just looking in based on what the company says. So I actually tend not to look at I don't know. Do you ever look at just what analysts are expecting?
No,
I mean, we
really
talk about it when the earnings do come out, say, oh, look how wrong the analysts were. But
yeah, I mean, they're just so wrong so much of the time.
Yeah.
I mean,
it's just guessing.
Yeah, it's just a guessing game, particularly when there's a lot of turbulence going on, like what we're seeing right now. Analysts have no idea. They're just throwing darts at a board.
Is there even a point? Yeah. Is there even a point to trying to predict Q2 earnings for 2020?
Yeah.
I don't think so.
Not at all.
Yeah, anyway,
we should get through our sponsor first before we jump into some economic updates and some earnings. It's a new sponsor. So we've got a sponsor, which is
really?
Sharesight.
Oh.
Yeah, brand new.
Sharesight, spelled SITE.
It's just a different company. No, same company. Don't listen to Brandon. No. So Sharesight is an application that you can use to do two major things. One is track the performance of your stock portfolio, and then also do some sort of help you calculate some things when it comes to tax time. So in terms of tracking your performance of your portfolio, it will allow you to do capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. currency gains if you're buying shares internationally or you just hold foreign currencies. And then in terms of tax time, it will allow you to generate up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you want to sign up to a paid plan, you can also use that link to get 4 months off when you sign up to a yearly subscription. So go check it out if you're interested.
Yeah, definitely. I didn't quite realize how tricky it is to track everything when it comes to tax time, like dividend income here in Australia, like franking credits and all that sort of stuff. And especially with dividend reinvestment plans, it just never registers in my brain that, when the dividend reinvestment plan happens or when the dividend's announced, then you're buying more shares. So you need to track that every single 6 months just because it's going to eventually factor into your capital gain. It's just a mess to try and keep track of it yourself. So yeah, well, you can definitely tell why Sharesight started their business, because they're definitely filling a need. So
absolutely.
Yeah. Anyway, I just want, before we get into the earnings, just kind of a few economic updates for Australia that I've kind of been noticing during the week. First thing I think was the unemployment numbers for June came out. So the ABS statistics for unemployment in June here in Australia. So in May, the unemployment rate was 7.1%, and in June it's gone up a little bit to 7.4%.
Right.
So it's still a decent increase, 0.3%. For a bit of context, before the shutdown, Australia has been in the unemployment range of kind of 5 to 5.4%, and that's been for the last couple of years. So 5 to 5.4% up to kind of 7.4%. That is quite a substantial jump up. But as we've said in previous podcasts, still nothing like the increases that we've seen in some countries overseas, like the United States, just because we've actually, say what you want about the Australian government, but the JobSeeker and JobKeeper plans, yes, they're flawed, but they actually have had quite a substantial impact in helping people kind of stay in their jobs, I guess, which is a positive.
Yeah, particularly when you compare to the unemployment rates in some other developed countries. It seems as though obviously no reaction by a government is perfect, but it seems to have done substantially better than some other regions at the very least.
I remember listening to that Ray Dalio TED Talk, and he was talking about how governments are trying to get this huge sums of money to their people. And yes, it's a huge sum of money. It's done in a relatively imperfect way, but at least it's being done. It's not like they're just going, oh no, we're too scared of forgetting one tiny thing that we're not going to do it at all. At least governments are kind of offering that assistance in this time. But I've got, actually, that brings me to the updates that were announced on the JobKeeper and the JobKeeper and JobSeeker payments. So I'm just reading straight off the article here. The JobKeeper wage subsidy will continue until March next year, but payments will fall from $1,500 to $1,200 a fortnight after September, and people working fewer than 20 hours a week will receive $750. That was the big problem I found with when JobKeeper first came in, is that you just got $1,500 regardless. It didn't matter if you worked 1 hour or 12 hours or 40 hours or 100 hours. It just didn't matter. You just got the $1,500. Yeah. And that was, to be honest, that was how I actually managed to get eligibility for JobKeeper. And that's what I think, there was so many little problems, because when I look at the people around me, I should not be eligible. I was not impacted at all really by the shutdown, which I'm very thankful for. But so for me, I got it through teaching my gym classes, and the gyms shut down over that period of time. And for me, I was only doing 2 classes a week at this gym, right? So it's 2 hours of work or something. But 2 hours of work that I said that got taken away from me, which really didn't impact my financial position too hard, which I was very thankful for. But that still gave me eligibility into this JobKeeper system where I was getting, and still am getting, $1,500 a fortnight when really I would only earn like $80.
Wow, that's crazy.
Yeah. So like, I guess I'm just lucky in that sense, but I'm the first one to put my hand up and say, no, there's something wrong with that system. So I actually welcome the changes where people that, were kind of just getting handed out free money for doing not very much work at all, there are those restrictions coming in. So people that are working fewer than 20 hours a week will only receive $750 a fortnight. So still some support, but not just like the free handout $1,500 like my situation.
Yeah, I guess when the government needs to make a really quick action to get money out to people, it's kind of a question of, do you go really broad and accidentally provide money to people who may not necessarily need it, or do you go, try and be very specific with which types of people get it, and then you have the case where some people might need it and they don't get it. So it's an impossible balancing act that's never going to work out perfectly the first time. And it seems as though they kind of had a very quick action to go broad, or relatively broad at least. There was still some people who thought it wasn't broad enough, but and now they're kind of, I guess, reeling it in a little bit and getting a little bit more specific. So.
Exactly. Yeah, just tightening it up a little bit.
Yeah, exactly.
So that's JobKeeper, and then we've just got Job Seeker payment will fall from $1,100 to $800 a fortnight in September as well. So both of those payment things, what do you call them? I don't know. Support packages. Stimulus. Stimulus. They all got extended, and it looks like they're going to go well into 2021 at this stage as well.
Interesting.
And then the last thing, economic update for Australia is that some retail figures out of the ABS showing quite promising signs. So I'll just read this article again. Figures from the ABS shows retail turnover for the month of June rose 2.4% compared with May, fueled by easing COVID restrictions that have allowed more businesses to open doors. June's monthly rise comes after May's really strong surge of 16.9%, rebounding from the April retail collapse that was induced by COVID-19 lockdown measures. The ABS said the monthly rises were spurred on by greater turnover in the hospitality industry, particularly in cafe, restaurant, and takeaway services.
Right. We'll have to see how that changes in July now that Victoria's big parts of Victoria have gone back into lockdown. So
looks like New South Wales might be headed that way.
I think so. Yeah.
So and that's the thing that really stands out with these figures is that they're always looking in the rearview mirror. So you say, oh, look, the Australian economy is really rebounding now, but you got to remember we're looking at last month. And even in the last 3 weeks, these numbers have changed quite dramatically. Like we're seeing that second wave, that bounce back in coronavirus cases. So we're probably going to see, once the figures for July get released, then that'll be going back down again, and we'll be seeing them in the month after. So we'll probably be saying, oh no, the economy's going back down the drain. But at that point in time, we might be seeing everywhere open up again. So it's just always worth remembering that these numbers are always backwards facing, they don't look into the future. So
yeah. All right. Should we get into some of the earnings for today?
Yeah, sure. Let's do it.
Yeah. So we'll start with the big one. We'll start with your favorite.
The big boy.
The Tesla.
So
the young
we'll
Tesla
start with
podcast.
Chipotle.
Chipotle. We could start with Chipotle if you want. Where should we start?
I don't know. Now we can start with Tesla. Right. I don't really know how many people actually follow, because I fully recognize that I'm a complete fanboy of Tesla, but I don't know how many of our listeners actually love Tesla like I do.
Yeah, let us know. So let us know in the comments.
Yeah, let us know. I don't know how long I should drag on with this stuff about Tesla. I could make a whole Tesla podcast, to be perfectly honest, just because I like the company.
And sometimes we do.
Sometimes, it just works out like that. But okay, we'll get through some numbers first up. So this is Tesla's Q2 results, 2020. Vehicle deliveries, that's the obvious place to start with Tesla. So they had vehicle deliveries of 90,891 cars, which is up 3% on last quarter. So 90,800 there, or 90,900 almost. And then production, how many cars they produced, was at 76,000. So that's down 13% versus the last quarter.
And is this compared to the first quarter? of 2020?
Yeah, first quarter.
Okay.
Yep.
Interesting.
Yep. Sorry, quarter over quarter. Yeah. So I thought that was probably the best way because we've been following how companies have been rebounding out of the shutdown period. I thought that we may as well compare it to last quarter.
Yeah.
So 91,000 cars delivered, 76,000 produced. So it just shows you that obviously the factory shut down for half the quarter really in Fremont really impacted Tesla's production. But they were still able to deliver heaps of cars because remember, they typically make a whole lot of cars, much more than they deliver in Q1 because Q1's seasonally weak for sales. And then during the year, they just chip away at that inventory. So that's kind of the case in this instance. Other interesting fact was 61% quarter over quarter increase in energy storage deployed. So they're big batteries. So that's promising. Of course, Elon says that he predicts the energy side of their business is going to rival the auto side of their business eventually at some point down the track. Right. So it's good to see that continues to increase, but it's still a very small part of their business at the moment.
What's the relationship between, I guess, their car business and their energy at the moment?
It's like 90%, 10%. In fact, it's more. It's even more auto than that. Okay. I can't quite remember, but yeah, it's definitely like in the 90% for auto versus energy is still tiny.
Yeah. Okay.
And then after that, revenue is only up 1% quarter over quarter, but I actually found that to be quite surprising. So they had $6 billion in revenue. They maintained a 21% gross margin, which is up slightly. It's usually around 18-20%. And the big ticket item for this earnings release is what everyone was watching is they had net income of $104 million, which is important because that number needed to be positive for them to meet the criteria for inclusion into the S&P 500 index. So hopefully, if all goes well, they should be included in that S&P 500, which obviously has, I guess it helps their stock be more stable just because it will be held by so many passive investors.
I have no idea what the outcome of that is. It's not something I've looked into particularly for businesses coming into the S&P 500, but it'll certainly be interesting. Yeah, because as I mentioned earlier, the news article that I saw that said they beat by 1,300% or something. The analyst expectation that I was looking at was expecting them to take a loss. So
that's why.
Yeah, very interesting.
Well, I guess, when it comes to S&P, I guess if you're running a company, I said, hey, Hamish, for your company, would you rather be in the S&P 500 or would you rather be out of the S&P 500? I think you probably just say, I'd probably prefer to be in it, to be honest.
Yeah, I mean, you would think that it would be beneficial because you have people who are passively buying the S&P 500 as an index and as a result, buying share into those companies. So, yeah.
There's probably a bit of a help over time.
Yeah.
What else to talk about? They added $535 million in cash to their cash balance. So they're now up to 8.6. So I think that's actually quite important to talk about because, I mean, this is Q2. This is the shutdown. Their factory was shut down for like half of the whole quarter. Auto sales just broadly are down like 30% or something crazy. And they were still able to add to their cash position. They weren't burning cash. Like we were talking about Delta Airlines, for example, capital intensive business last week, and they are just burning cash. Whereas Tesla was still able to produce or add to their cash position. They generated $418 million of free cash flow. And I think that's interesting as well because free cash flow obviously just includes all capital expenditure and they're pumping so much money into growing at the moment as well. So they're putting all the money they need to into growing. They've got like 5 gigafactories on the go at the moment, which is insane. And they're, trying to build Model Y production lines and yada, yada, all the rest of the stuff they're doing. They're still free cash flow positive. So I think that's pretty good.
Yeah, I mean, it's certainly not typical for an auto company in a very highly cyclical industry to see a revenue increase and to be able to grow their cash position during some kind of weak economic period. So I think it clearly shows that there's still a lot of tailwind in terms of demand for Tesla vehicles, even though there's been a substantial slowdown in the broader auto industry. So very, very impressive. Not something I expected to see. It'll certainly be interesting to see how this plays out over the next year, I guess, or so. If they can continue to do this, then they're not in any trouble of struggling through this recession.
Yeah. That's what I was thinking. Like the takeaway out of these numbers here is that like this is the worst quarter, the real big shutdown quarter where, people were having to stay indoors and, not go out and were not allowed to go to work and blah, 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 for literally like half the quarter. So they got half the quarter taken away from them and they were still able to do this, which like I find that pretty impressive. And especially the fact that in the horrible conditions that we've seen over this quarter, they were still able to add $535 million to their cash balance. I think that's a pretty good sign that Tesla are going to make the calls needed to be able to get through this shutdown period. Okay. Moving on to the conference call, I don't want to drag Tesla out too long, so I might just go through some interesting things. They announced the next Gigafactory. So they're going to build their next Gigafactory 5 minutes out of Austin, Texas. They said, this is really interesting, they said it's going to be built on the Colorado River, and Elon said it's going to be an ecological paradise. So they're going to build like boardwalks and walking and biking trails, and it's got. I'm envisaging this to be like a nice kind of nature reserve, public park kind of thing. Because he did say it's going to be completely like the facilities are going to be completely open to the public. Wow. So I don't know how that works. Like when you've got a workplace and it's a gigafactory and they're building cars, but he said it's going to be open to the public and boardwalks and playgrounds and blah blah blah.
One thing about Elon Musk is he certainly knows he's certainly a very good marketer. Be able to market, have that sort of premium vehicle quality that he's been able to build very quickly, that sort of premium brand. And doing something like this is just, it's a huge marketing move, pretty much. That's the way I see it, at least.
But I hope it looks cool. I mean, I looked at some of the photos for the Berlin Gigafactory, and that looked very nice. It's like surrounded by all these trees and looks awesome. Anyway, so in terms of the actual functionality of this Gigafactory, it's going to build the 3 and the Y for Western North America, and then it's also going to build the Cybertruck and the semi-truck as well. Interestingly, construction on this Gigafactory has already begun. So there you go. Watch this space. What else did they say on the conference call? Oh yeah, the solar products that Tesla now offers are about 30% cheaper than the industry average. So wow. I found that quite interesting. That's quite a sizable lead. So hopefully that helps them gain more and more traction in their solar business. The Model S now has 402 miles of range, which is pretty crazy. Autopilot updates. They're just gathering lots of data at the moment. They're making the traffic light and stop sign recognition more robust. In terms of autopilot, though, he came out and said that they should be fully capable of fully autonomous by the end of the year or something like that? Yeah, he did say that. And the reason, what I learned from listening to the conference call is they're developing this new way that autopilot is going to kind of map its surroundings, this 3D environment that it's running through, and they're kind of working on that new system in the background. So the gist I got is that once they actually open that up and implement that and switch it on for all the cars, then the improvements get more significant more quickly. So I think they're kind of in a bit of a holding pattern with autopilot at the moment as they work on this new system that they're going to implement. Right. And then once he predicts they're going to put that in the next couple of months. And then once that happens, then it's going to be very, very fast getting towards full autonomy. He said that he's running the latest software version, a test version of the latest software in his car that he drives around because he tests it every day. And he says basically every day he gets in his car and he switches on autopilot and it takes him all the way to work with very minimal interventions. So that's promising, I guess. And I think that's why he is so confident, is because he's driving the most up-to-date test software, I suppose. So
man, that's so exciting. I cannot wait.
It is. It's very exciting.
It's just amazing how over the next, Tesla's certainly leading the charge, but over the next 5 to 10 years, we could expect a substantial amount of cars to be fully autonomous capable, which is really exciting. It's something, it's probably going to be one of the big, technological innovations that we'll see for our generation.
For sure, yeah. He was talking about too just the economics of it all and having that robo-taxi network, and he was just rattling off some numbers how the utility of the car with autonomy goes up by like a factor of, I don't know, 5 or 6 or something like that. So yeah, he was just running through, you know, he believes, in his opinion, that having a fully autonomous car is going to be the single biggest like step change in asset value that we've basically ever seen. He predicts that cars will be, you know, at least worth more than $100,000 more if they can be fully autonomous, because then they can be plugged into this taxi system and just generate you passive income. He's still standing by it. He said that he predicts at the moment with their modeling that you could earn $30,000 a year just by putting your car whenever you can into the Tesla robo-taxi network and just collecting passive income. Imagine that. That'd be awesome. I definitely, if the Model 3 costs $100,000 and or not even, maybe well, let's just say $100,000, whatever, and it makes me $30,000 a year, then for sure I'm going to do that. I mean, I'll buy heaps of them. You think about that as an ROI, you're going to get your money back in 3 years.
You don't even need to put money down. You could just get a car loan. And the car loan's what, 4%?
Yeah.
So
you just start printing money.
You're paying 4%. Yeah, it's insane. It kind of turns into the economics of buying an investment property. Far better if they can generate 30,000, but the economics in the way that you're outlaying interest payments and you're inlaying or having inflows of rental payments. If the same thing can be true for a car, that's crazy. That is insane.
Yeah, exactly right. And that's why I'm just so excited about what this company continues to work on. Like, I just can't wait. I can't wait to see how this all plays out, because like people refer to it as the iPhone of cars, but I really do believe that. It's that big of a technological advancement. It really changes the way that we think about these things. So, I mean, up until now, cars have just been thought of as terrible investments, depreciating assets. I mean, it's just going to be worth basically nothing in 5 years, so don't buy one if you can get away with it. But now it's just completely flipping that thinking on its head. So anyway, I think that's pretty cool.
Yeah, everything is going well for Tesla over the past 6 months. It's been crazy. What's the stock price up? 180%. I'm looking at it the past 6 months. Past a year, 500%.
Yeah.
It's a great story.
There's so much. It's a great story. There's so much innovation. I mean, I think we'll leave it there, but we haven't even touched on some of this other stuff. Like, they're talking about Tesla insurance, for example, and they're going to revolutionize auto insurance as well, because instead of just charging a pretty boring, flat, kind of premium for everybody, kind of like a one size fits all kind of thing, they're going to be able to offer Tesla vehicle owners specialized individual insurance based on the way they drive their car, because they get all the data. It's like they get sent, do you drive erratically, or are you a very good, very safe, conservative driver? If so, you don't have to pay much in insurance at all. If you drive like a moron, then you're going to pay heaps in insurance. It's like the power's in the data, and Tesla have got such a data advantage right now that it's going to be hard to stop them, I think.
Unbelievable.
Anyway,
we'll move.
Stop me now! Stop me now!
Yeah, we've still got some time for a couple more. We didn't use up all our time. No, we'll move into Netflix now. And I know that Netflix is one that quite a few people follow. So Netflix reported their Q2 earnings as well. So revenue came in at $6.3 billion, which was up 25%. That's year over year. So still growing at a pretty high rate. Earnings per share came in at $1.59, which was up from 60 cents a year ago. So almost 200% growth there in terms of their earnings. In terms of subscribers, so over the past 3 months, they added 10 million new subscribers. So that's kind of the big highlight, I think, of their earnings, is that they added 10 million new subscribers. I think the quarter before that, they added something like 4 million new subscribers.
Really?
So still a substantial increase in the number of people coming on. And that's to be expected. A lot of people are staying home, and Netflix's management believes that a lot of those subscribers are people who wouldn't have normally bought a Netflix subscription. So they're bringing that forward because of the lockdown, the situation that's happening. So this has just been one of those companies that's been able to benefit from the shutdown, really. One of those few companies alongside something like Zoom as well, that actually had a business that kind of fit quite nicely into people working from home and living from and staying in home a little bit longer. Yeah.
I was just going to say, I find this interesting because I remember last quarter, Netflix came out and they said that because remember last quarter, they had the amazing subscription numbers come in for Q1 because that was when we were first entering the shutdown. And they were saying that, it looks really good for us now, but we predict that maybe the next few quarters might be weak because we think that amazing subscription number is just draw forward. It's just pull forward. Like people that were thinking about Netflix or were probably going to sign up in the future have just decided to bite the bullet now because the conditions lend themselves to having Netflix now because of the shutdown. So it's interesting to see that even this quarter, like they were saying that, we don't expect our next couple of quarters to be all that great because we think that anyone that's going to sign up in the next few quarters just signed up in this quarter.
Yeah.
So it's interesting to see that 3 months later, they're still adding considerably large numbers of subscribers, which I guess that's good.
Yeah. I mean, I don't think they were expecting Q2 to add even more subscribers than Q1. I think they expected that Q1 would have been the largest because that was the beginning and the height of the shutdown for most regions. But Q2 was even better. So that brings their total subscribers to 193 million, which is up 27% year over year. So I mean, they're still growing the number of subscribers at a ridiculous rate.
It's good. It's crazy.
It's just crazy how many people have a Netflix subscription. 200 million people. Wow.
They're next quarter, they're probably going to have 200 million.
Yeah, exactly.
That's insane.
Yeah, like as you mentioned, so they're expecting the second half of the year to have bad comparisons to the second half of 2019 in terms of subscription ads. I can't remember the number off the top of my head, but I feel
so. It might take them a little bit longer.
Yeah, it was somewhere in the 2 to 6 million subscriber range that they're expecting over the next
That's
6 months.
Quite a range.
Yeah, I mean that's just
2 to 6.
That's just the range I just pulled out of my head. I can't remember what it was specifically.
Okay.
They would have.
I thought that's something they said. In that case, it's going to be like, wow. The question I'd asked on the conference call, can you be any more specific?
We're going to add somewhere between 1 million and 17 million subscribers. Thanks everyone for coming. Next quarter. Oh dear.
Our revenue will come in somewhere between $1 and $10 billion.
Enjoy. Have fun, analysts.
Yeah. Good luck.
In terms of so their average revenue per user, which is also something to watch. So Netflix is, I think their revenue is quite simple to understand. It's either how many people are subscribed and how much are each of their subscribers paying. So they increased their average revenue per user by 0.4%, so pretty small, but during the period, they actually increased pricing by 5%. So that's not necessarily in everyone's subscription. So you might have not seen an increase in your subscription, but overall, they've increased the price of, I guess, average revenue per user. Maybe they increased it in one particular region. But that 5% increase was actually offset by currency. So they saw a 3.6% decline, 4.6% decline from currency. So just shows as currency has sort of been fluctuating quite a lot recently, it's having an impact on businesses that collect revenue in a number of different currencies, not just in US dollars or not just in Australian dollars if it's an Australian business. Yeah, that makes sense. If you have a lot of international revenue, you have to pull it back into US dollars then. That's a bit rough when the US dollar is so strong. Yeah, exactly right. Yeah. In terms of sort of cash flow and debt, I think cash flow and debt's kind of been the area I've been most interested in terms of Netflix. So in terms of cash flow, they were positive for the second quarter in a row. So they've actually been, so prior to the last two quarters, they've been terribly negative in terms of free cash flow. So that's obviously a positive sign. So they had free cash flow coming in at 900 million.
Wow, okay.
And management basically said that cash flow is improving due to them making more original content versus licensing other people's content. And how that works is that when they make their own content, there's higher upfront costs because they have to do all of the production, obviously. But once they've made the content, there's no or very little ongoing fees that are associated with their original content. Whereas when they're licensing other content, they have these high fees that are just ongoing. They're paying, for a year's worth of a certain series, and they have to pay out to another studio. So they're quoting that as a reason why there's been this sort of transformation of being very cash flow negative when they started up, when they were just buying other people's or leasing other people's content to provide a lot of content, to now they're making quite a lot of their own content. Right. Yeah. And then for the first half of this year, so Q1 and Q2, they had $1 billion in free cash flow. So as I just mentioned, most of that came in Q2. And one thing I just had a quick glance at their market cap. So the price for the whole business, their market cap is about $200 billion at the moment. So they've got quite a long way to go from a value investing perspective in order to justify that market cap. I mean, if that's a half year, if you assume that goes to 2 billion, which it may not go to 2 billion, but let's just assume that you're still earnings is cash flow is still only 1% of the price that you're paying. So I thought I'd just include that in there. But
you think if you just did like owner's earnings and you didn't even, I mean, you should do, maintenance CapEx, but just that's insane. Yeah, you're right. It's a long way.
Yeah.
Long way away.
And Netflix is a tricky one for figuring out cash flow because, yeah, you're right. If you're trying to just include maintenance CapEx, then really the question you're asking is how much of the money they're spending on their production and on their licensing fees, how much of that is contributing to growth of the platform and how much is just maintenance.
That's true.
I think I've made the argument before that a substantial amount of that is still just maintenance because you can't just stop adding content if you're Netflix. To keep me as a subscriber. I constantly run out of things that I want to watch, and I'm constantly waiting for a new Netflix original to come out or them to add an older series or something like that from another production company.
And I think that's what Warren Buffett said when in that, what was it, 1986 something letter to shareholders when he first introduced this concept. He wasn't just saying, maintenance, capital expenditure, just the cost that the company needs to, maintain its revenue capabilities. He said it in a way where it's like, actually maintenance capital expenditure is the amount of money that they need to spend each year to maintain their competitive position. So you could argue for a company like Netflix, sure, maybe they don't need too much just to keep the business of Netflix just turning over. Yep. And you might think adding new shows, well, that's just growth capital expenditure. And if you think about it that way, then yeah, it is growth because you're making new shows to build the platform. But in terms of being able to maintain their competitive position, a lot of that growth capital expenditure of making new shows is actually maintenance capital expenditure because they need to spend that just to, as I said, maintain their competitive position. So just some things to think about.
Yeah, absolutely. All right, so we can talk about debt now.
Gosh,
let's play a game. How much debt did Netflix take on this quarter? Have a guess.
Geez,
I'll give you a range.
I'll give you no idea. Okay,
I'll give you a range. All right, somewhere between 500 million and 2 billion.
500 million and 2 billion. 500 million to 1.4. I don't know.
1.4 billion. Ooh, very close. So they added $1 billion in debt.
1 billion.
Some people are probably listening to this wondering what the hell I'm talking about. But Netflix, every quarter, they add a ton of debt. So it's always interesting to see how much they added to their total pile. But they added $1 billion this quarter, and that brings their total at the moment to $16.3 billion. So they're certainly not short of debt at the moment.
It's like 5 years ago, that number was 2 billion.
Yeah. And I mean, 1 billion in a quarter is probably one of the lowest quarters I've seen. I've seen some that have been 3 or 4. So they've kind of pulled back on the debt raising, I guess, but still substantial.
Man, I love Netflix. Like as a product, as a service, I love it. Like I like watching shows on Netflix and all the content they offer. But man, I just hope the management team is good enough to manage that debt.
Yeah. And I mean, it's one of those businesses where it's almost necessary to use all of the capital, all of the money available to them, including debt, to just stay ahead of the competition. So that it's kind of just the nature of the business, but that still doesn't mean that it excuses or, reduces the risk to shareholders for that debt. It's just that I think any business in their position would probably be doing the same thing. That's kind of just the nature of the business.
It's definitely necessary. I mean, a few years ago, their business was simply license other people's content that people love to watch and put it on your platform. Now that's not a viable business strategy anymore.
Yeah.
So now they have had to change their business strategy to make original content that people want to watch more than everyone else's original content. And that's just the nature of the original content holders like Disney or whatever making their own streaming service. And we've spoken about this heaps before, so we won't bang on about it. But yeah, exactly right. So, I mean, they've just been forced. Like this is not an option. If they didn't go down this route, then we would basically be watching nothing on Netflix. So it's necessary. And, to do that, they have to utilize every single ounce of, financial support they can get, whether it be from banks or investors or whatever, to try and just make this change happen. And I just, I don't know. Like, yeah, I hope that there's competition between Disney and Netflix. I mean, to be honest, if I had an investor cap on, then I hope that Netflix puts out of business and Disney can just take over and I can make money investing in Disney stock. But in terms of a consumer, like I hope there's some competition between Disney and Netflix and Amazon, so that they keep each other honest and they keep making great shows, because that's just competition is great for a consumer. Competition is not great for an investor, I suppose.
Yeah, that's a really good way to put it, I guess. Because, I mean, ideally for a consumer, there'd be tons of competition, prices will be driven down, and as a consumer, you can have your pick. You can have a Netflix, you can have a Disney Plus, you can have a Stan in Australia, you can have a number of different ones and tons of content available to you. But if that's not the case, then and you have one that has a very controlling force in the market, then you're probably going to see some price increases from that one player, which is not exactly. Good for the consumer.
And that's what people. I've just been following on. People have been getting annoyed at Adobe recently, just because Adobe is just such a dominant player that they can just get away with doing whatever they want. And there are so many things that have been, frustrating Creative Cloud users lately that I've just been keeping track of. And people are just getting annoyed because Adobe, they can take their sweet time in fixing these issues. They don't have to rush because there's just no one in a competitive position to take on Adobe and make, artists or video editors or, illustrators, whatever, switch to another software package. So it's just, exactly right. Like Adobe's sitting there going, oh, this is great. There's no competition, whatever. We can do whatever we want. We can still rake in the millions. At the same time, us consumers are like, oh, come on. I wish there was competition. So it keeps the other companies in check so they actually make products that work. Because gosh, damn it, I get so annoyed when halfway through editing a video on Premiere Pro crashes.
There are so many bugs. It's really bad. I'm always so reluctant to update my Mac, for example, to the latest version, because as soon as you update your Mac to the latest version, Adobe's not going to be compatible with it for at least 6 months or something like that. So it's just, it's a bit of a disaster.
A bit frustrating like that. Anyway, do we have anything else to add?
Yeah, there was just one other thing I wanted to talk about, and this was something I found kind of interesting in relation to their content. So the management said that content that releases in 2020, so this year, they're expected to be largely unaffected. So they're still going to be producing and releasing all of the shows they expect this year. And the reason they said was because most of the time they produce shows about a year in advance. So anything that was scheduled to come out this year was produced prior to.
It's been filmed.
Yeah, it's been filmed and produced prior to the COVID situation. In terms of next year, however, in 2021, they expected that the first half will be a lot of the first half productions will be pushed into the second half of 2021. Right. So obviously that just depends on if they can even keep up with the current schedule that they're operating at. But we'll kind of see how that plays out. And they said that although there still will be more productions in 2021 than in 2020. So even though next year is going to be a little bit disrupted because that right now they have a limited ability to film live action shows. They still think that they'll be able to produce more original content next year.
Oh, good.
Yeah.
Cool. Sounds good. Oh, very good. All right. Should we wrap up Netflix and move on to our next one?
Yeah. This is a really important one. I know that this one has a close place in many of our listeners' hearts. This one being Chipotle, and more importantly, the Chipotlane update that came
very
with Q2.
important.
Q1, we didn't get any Chipotlane update. Was very disappointed that I had to wait 6 months to get any news out of that. But
well, I wrote to the CEO. I just said it's just not good enough.
Yeah,
we need, as shareholders that are invested in your business, let's be honest, for the Chipotlane, because it's such a revolutionary product or service. We need to be informed as shareholders, and quite frankly, your integrity as a CEO is falling because you're not giving us the updates we need. Yeah, so I guess he must have received my telegram.
Yep, that's what happened.
He was just like, I don't know what to say to that.
This is too perfect. I had nothing to add to that.
Yep. Yes, great one, Brandon. I guess that's what happened.
Good job, Brandon. Nice.
Anyway.
No, so we'll go through some of their core numbers and then we'll get into the Chipotlanes.
Yep.
We'll build up to it. So we had revenue coming in at 1.4 billion, which was down 4.8% year over year, and that was driven by comparable sales growth, which was down 9.8%. So still seeing substantial declines in the number of people coming and spending money at Chipotle restaurants, which is no surprise to anybody. In July, however, so this is the first month of Q3, so they provide a little bit of data there. They say so far that their sales are up, comparable sales are up 6.4%. So they're actually seeing an increase year over year, that is. So compared to July of last year, or the first couple of weeks of July of last year. So that's certainly positive. It shows that their business is still growing, and 6.4% comparable sales in of itself is insane.
What a bounce back.
That's an insane figure, but it's probably a moderate figure for Chipotle. They'll probably end up doing 15 or 20% comparable sales growth because they're just it's just been very impressive for them. In the quarter, digital sales accounted for 60% of their revenue. So a big reason why they were only down 4.8% in revenue, which is pretty low if you look at other restaurant chains, is because they were able to adapt and take a lot of orders online as well as people picking up in store. So that's been able to help them out on the top line. Although very low margin restaurant company, it did not help them on the bottom line. So their earnings came in at 29 cents, which was down 91% year over year. So earnings were smashed basically. And in terms of their restaurant openings, they opened 37 restaurants, bringing their total to 2,669. Management said, and I quote, "We will continue to invest in elevating the digital experience, including opening more Chipotlanes." So they opened a few.
Yes, come on.
So they opened. So 21 of the 37 new restaurants have Chipotlanes. So most of them. And here's the big kicker: they opened their 100th Chipotlane in the quarter.
Oh, yes, congratulations, Chipotle!
Big milestone.
Oh, I knew it. We knew it. We knew this was going to work out. We knew they were onto something with the Chipotlane.
Yeah, it's only a matter of time before that's 100,000 Chipotlanes across all different kinds of restaurant chains throughout the world.
This is a win for the Young Investors podcast. You heard it here first. Man, we should be analysts. We absolutely knew they were onto something with those Chipotlanes. Man, I would just run it. I would run this business in the negatives just to invest as much as possible into the Chipotlane.
Get as much debt as you can.
Keep going. Just go. As long as it's Chipotlanes, just keep. Put in 10 Chipotlanes per restaurant.
Put in a Chipotlane where there isn't even a Chipotle restaurant. Just put the Chipotlane in there.
Just put the Chipotlane. Just the lane.
Yeah.
It's got the little it's got the box that comes out. They still say, "Hey, welcome to Chipotle. Can I take your order?" And then you have to go and drive to a Chipotle to actually go and collect.
Yeah, you just go around the corner and there's just nothing there. Chipotle restaurant coming soon.
They're going to put them at intersections, right? So at stop signs or at traffic lights, they're going to have the little pop-up box. And then when you stop at the red light on the line, it's just going to say, "Welcome to the Chipotlane. Can I take your order?"
Absolute genius.
And then you have to go. I mean, you're forced into it there. You're forced. You have to go to the Chipotle and pick up your order.
Amazing. Absolutely brilliant.
I mean, there's just so many different ways this business could take the Chipotlane. I'm just excited to see what management comes up with next.
Yeah, we'll see in Q3, or maybe they'll continue their trend of not telling us any updates about Chipotlanes in the odd quarters. So.
No, they wouldn't do that.
Yeah.
Not after my horrible letter I sent them. No way.
Yeah.
Anyway, enough joking around for one day, I think. It's kind of good to finish like that, though. A little bit lighthearted.
Yeah, no, it's
after
good.
We delve into so many numbers. My brain's fried.
Yeah.
Anyway, we should get it. We'll do a couple of Q&A questions and then maybe wrap things up after that.
Yeah, absolutely.
We should probably say as well, if there's any companies I think we said this last week, if there's any companies you want us to particularly look at, then just let us know in the YouTube comments and we can kind of add it to the list and see if there's a big demand for some companies or other companies, and we can just analyze as per what you guys want to hear. Because we really don't know. Like, we follow these companies that we talk about. We don't really know if you guys care about them or not.
Yeah, definitely. Yeah, tell us which ones you want to see. I think the only one I could really that stuck out to me next week was Starbucks, and then Google reports on the Thursday, which is the day we record. So that's kind of a 50-50 as to whether we get to that one next week or the week after.
Yep. Yeah, so I don't know. We'll see. There's a couple of interesting ones I'm sure we could talk about. We could probably talk about, I think, Boeing's coming up soon or something like that. There's a couple of interesting ones. Anyway, so let's get into some Q&A.
Yeah, let's do it.
Let's do this first one. Any views or financial reports on standard ASX blue chips like the Big Four or Telstra? This is a bit directed to you with what you do with your platform, I imagine.
Oh, yeah. So, I mean, in terms of my view on any of these companies, the Big Four, certainly outside of my circle of competence, just not within an area that I'm interested in, nor in an area that I have any kind of decent understanding. So, and the same is mostly true for Telstra, I would say. So on an individual level, I can't analyze them as an individual investment, but I hold all 5 of those businesses as a part of the ASX 300 index fund that I own. So I own a bit of them, but I own them in a basket of the top businesses in Australia rather than analyzing them as an individual investor and coming up with a reasonable picture of where they'll be in the future.
Yeah, I have quite a similar opinion with these sort of companies. I was keeping up with Telstra for a while. Like, obviously with telecommunications companies, I think there's obviously big potential in the kind of next generation of 5G and mobile use and mobile data, and just our lives being more heavily reliant on data and internet and so on and so forth. So, like, I think that telecommunications is going to be obviously a massively, like a big grower into the future, just as our lives get more dependent, file sizes get bigger, high definition, only increases 4K to 8K to whatever. So it's definitely going to be continued demand for that sort of stuff. When it comes to banks, I mean, I just don't care. That's just the sad reality of it. Like, Commonwealth Bank annual report, I'm asleep by halfway through page
700 pages long.
Yeah, I reckon.
Yeah.
Just like, it just takes me so long to understand like the industry trends and what happens. And to be honest, I just don't care about it. So that's why I don't look into banks. I find it much more interesting looking into companies that are innovating, doing things differently, making new products, new services, doing things that are going to influence the future in a big way. So technology kind of companies, that sort of stuff.
Yeah. All right. I'll ask this next one to you. Which one do you want? The next one or the one after?
Oh, hit me with either one. I don't care.
I'll give you this one. Could you please talk about the process of running numbers on companies in the current climate where numbers are all over the place?
Yeah, certainly difficult. I guess first things first is the things that are important to look at when it comes to numbers are, survivability of your company. So, you definitely want to have a look at how heavily their cash flows have been impacted, and also what their debt burden is, like how much debt have they taken on? Are they going to be able to, meet those repayment requirements, even if they have a substantial hit to their revenue? I mean, we've seen that already. So you can have a look at Q1. You can now almost have a look at most companies for Q2. You can start having a look at that. That'd probably be the number one thing. But when it comes to growth, and you're thinking about how is this company going to grow into the future, I mean, these are tough times. So there is unpredictability in the near term with this whole coronavirus stuff, but in all honesty, I wouldn't look too much into I suppose I would give, if the company is a solid company and growing well pre-COVID-19, I would give them a bit of a pass when it comes to the conditions that they're suffering in, like COVID conditions. And I would just look at, what in normal conditions, if we say this is only a 1 or 2 year issue, which, I mean, if you're owning stocks, you should be looking to own them for like 10 years. So if they get through this okay, then what are they likely going to get back on track? And can I, if I buy now with these depressed share prices because their business is struggling, it's not going to go bankrupt. If they get back to their normal growth rates, which they've proven time and time again they can manage in normal conditions, if they can hold that for a long time, is this a stock that's worth me considering, I suppose? Yeah. Does what I said make sense?
Yeah,
I don't
perfect.
know if that makes
There's really
sense.
nothing more I can add to that. The only thing I would think of off the top of my head is that you mentioned, in the short term, survivability, that's super important. And then, of course, as you said, if it's you want to make sure that the businesses you're investing in are strong businesses with distinct advantages, so that even though they in the short term now their revenues and profits might be depressed, might be down, you need to make sure that customers are actually going to be coming back on the other side of this, drawn into that business because they have something unique, something that they can't get from other businesses. And that's kind of where we look at competitive advantages, making sure that customers come back strong. But yeah.
Yeah. All right. Next one. Let's go on to this one here. What are your thoughts on Tesla's $1,500 stock price?
Overvalued. No.
Overvalued. Full stop.
I wrote that down just as a bit of a laugh. But I mean, this isn't a company that I haven't sort of followed it very closely. I haven't done any analysis on it. So I actually don't know really. I don't really have an opinion as to whether it's overvalued or undervalued. All I can do really from a very basic perspective is look at their market cap and compare that to their current cash flows, which is very flawed, considering they're a high growth company. And Brandon's pointed out to me that there's, they're spending a lot of cash at the moment that will result in growth that comes later, which means that, from a very simplistic point of view, many people might say, oh, that's overvalued. But as someone who hasn't analyzed it and doesn't have a deep understanding of the auto industry specifically, the industry Tesla operates in, then I don't really have too much to comment on it. It's doing very well for shareholders though.
Yeah. I mean, there is no doubt if you just look at where Tesla is right now, then you'd be crazy not to say overvalued. If you're just looking at, say, even if you give them a pass on the coronavirus stuff and you just take the 4 quarters of 2019 and you look at their, cash flow, their owner's earnings and whatnot, and then you compare it to their current market cap, it is dumb. It is stupid how expensive this stock is. But then again, on the other hand, you've got a company that is growing extremely quickly. And for instance, Elon, whether you believe this or not, I'm a little bit skeptical just because I know they shouldn't, as a company, they shouldn't be viewed as an auto manufacturer. They should be viewed as much more. But that's how they make their money, right? They make cars. And Elon's come out and said in the past that he predicts there'll be 50% growth in Tesla's business per year for, many, many, many years to come. And when you look at the auto industry and just how many costs are associated with, how even if you ramp up your revenue, your costs ramp up almost equally as quickly. So it's just, if Elon is a remarkable innovator, engineer, business manager, whatever. if he can hit 50% growth every year, and you look out to the long term, you look out 10 years, and he's able to hit 50% growth, then actually the stock doesn't look so crazily overvalued if you look at like a discounted cash flow. But you got to ask yourself,
it's a big if.
Is a 50% growth rate, like I know this is Elon Musk we're talking about, and he has done some remarkable things, but is that possible? I mean, if we looked at any stock, just forget we're talking about Tesla, and then you put into your spreadsheet 50% growth each year for the next 10 years, would you feel at all confident in doing that?
Yeah, I think that's the right way to think about it, because you want to, whenever you're doing a value and coming up with an estimate of what to pay, you should be using growth rates and future cash flows that you think, well, this is my view, that you think is most likely going to happen. Not necessarily what's just something that's possible, but what is most likely, or something that you're very confident will at least happen. I couldn't imagine myself using 50% and feeling as if that's a most likely outcome for any business. But again, as I said, this is outside of my area. So
yeah. But even if you think about a completely different industry, think about social media, right? Think about Facebook as a company. They are in just a money printing position where they don't have to spend all that much on maintaining their platform. And they literally don't have to build anything physically. They don't have to build a car to then go and sell it. They don't need they don't need factories. And even that's a perfect money printing business. They literally just enable space on your screen for an advertiser to show an ad, and they show that ad and then they get given money. I mean, that is just money printing at its finest. But even a company like Facebook, you look at the 10-year average and it's still only, 20, 30 something percent per year. And that is like in an industry where they, like I said, they are just printing money. And then we're looking now at a company which is essentially at the moment an auto manufacturer. At least that's how they make their money. And then you want to do 50% per year?
Yeah.
Oh, man. It's just hard. I mean, I know don't count out Elon Musk, but I mean, that's rough. That's very hard to do.
Yeah. All right. Should we leave it there?
Yeah, I think so. We're at about the hour mark, so I think that's probably a good time to wrap it up. Thanks very much for listening, guys. We super appreciate it. And yeah, like we said, if you got any Q&A questions, then definitely chuck them in the comments section of the YouTube version, youtube.com/The Young Investors Podcast. Did I get it right that time?
That's correct. The Young Investors Podcast.
Nice. And yeah, so we'll go through a bunch more probably earnings reports next week, plus the usual array of news topics. And yeah, if you want us to look at any company particularly in depth or give our insights wherever we can, then just let us know. But I think that'll do us for today, guys. Thanks very much for listening, as always. Thanks, Hamish, for coming along and talking Tesla, Chipotle, and Netflix with me.
No worries at all.
And we'll see you guys next week.
See you later.